Three themes dominate the latest proposals. First, a significantly longer tax holiday for IFSC units. Second, a one-time concessional duty route for SEZ manufacturing units selling into the domestic market. And third, a restructuring of minimum alternate tax rules that directly impacts cash flows and long-term tax strategy for companies still in the old regime. Impact how to use sets the strategic lens for CFOs and promoters. Helps identify which proposal matters most to your group. Useful framing for board or investor discussions. In this video, we break down the Finance Bill 2026 IFSC and SEZ and its related sector, what changed, who is impacted, what it means for cost, compliance, and cash flows, and what actions you should take now. The Finance Bill 2026 provides different effective dates across tax laws. Most provisions apply from April 2026. Some customs tariff changes apply from a later notified date, while certain GST amendments will come into effect once separately notified by the government. For IFSC units and offshore banking units, the Finance Bill expands the tax holiday framework. Eligible units can now claim deductions for 20 consecutive tax years, or alternatively 20 years out of a 25-year period at the taxpayer's option. The bill also tightens eligibility conditions for units commencing operations from April 2026 onward. Such units must not be formed by splitting up, reconstruction, reorganization, or transfer of an existing Indian business. In addition, the bill clarifies the concept of the relevant tax year, linking it to regulatory permissions and registrations, including those under the IFSC Act 2019. For existing IFSC units, current tax holiday claims remain unaffected. The extended deduction window improves long-term certainty, especially for capital-intensive activities such as aircraft and ship leasing. However, existing units must continue to maintain clear documentation to support their original eligibility, particularly where internal restructuring or group expansions are involved. The government has also proposed rationalization of tax provisions applicable to treasury centers operating in IFSC. Under the proposal, the provisions relating to deemed dividend will not apply to treasury centers in IFSC, subject to specified conditions. One key condition is that the parent or principal entity of the group must be listed in a country or territory outside India. Additionally, both the parent entity and the other group entities involved in the transaction must be located outside India, in jurisdictions as may be notified by the central government. These changes are aimed at enhancing tax certainty, improving ease of doing business, and positioning IFSCs as globally competitive financial hubs. For existing IFSC treasury centers, this change significantly reduces exposure to deemed dividend taxation, provided the prescribed conditions are satisfied. Groups must review their listing status and the location of participating entities to ensure continued eligibility under the notified jurisdictions framework. For SEZ manufacturing units, a one relief is proposed to allow sales into the domestic tariff area at concessional rates of duty. The quantity permitted will be capped based on a prescribed proportion of exports, with operational details to be notified separately. The intent is clear to provide flexibility during weak export cycles while preserving a level playing field for domestic manufacturers. Impact how to use existing SEZ units. Monetize idle or underutilized capacity. Improve cash flows and inventory turn. Requires tight export tracking and duty computation. Treat this as a tactical window, not a permanent shift. The proposal reduces the MAT rate from 15% to 14%. But the bigger shift is structural. The direction suggests that MAT paid under the old regime may increasingly be treated as final tax, with restrictions on creating fresh MAT credit and changes to set-off rules. The policy signal is clear, encouraging a gradual migration away from the old regime. Impact how to use existing companies. Companies in old regime must re-evaluate stay versus switch. MAT credit utilization planning becomes critical. Capex-heavy businesses should rework book profit projections. MAT is now a strategic decision, not a compliance byproduct. To attract global digital business, the proposal offers a tax holiday up to 2047 for a foreign company serving customers outside India using data center services located in India, subject to conditions. Indian user sales must be routed through an Indian reseller and taxed separately. Additionally, a 15% safe harbor is proposed for the Indian entity providing data center services to its related foreign company. Impact how to use existing new structures. Strengthens India's case for global cloud and platform groups. Provides pricing certainty in related party DC arrangements. Existing groups should assess operating model alignment. Contracts and routing must strictly match conditions. To boost electronics manufacturing, an exemption is proposed for foreign companies supplying capital goods, equipment, and tooling to toll manufacturers operating in bonded zones. The benefit applies for 5 tax years starting from 1st April 2026. Impact: how to use existing manufacturing setups. Reduces friction in cross-border tooling models. Makes India more attractive for contract manufacturing. Bonded zone compliance and documentation become critical. Useful for groups reshaping Asia's supply chains. Over the next 30 to 60 days, businesses should move from awareness to action. Map eligibility across IFSC, SEZ, bonded zones, and foreign company structures. Build scenario-based financial models. Prepare for tighter documentation and watch closely for notifications that will determine the final shape of these benefits. Impact: how to use. Convert policy into board-level decisions. Avoid last-minute restructuring risks. Ideal moment to reset long-term tax strategy. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling complaints. Risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BATF, and ancillary regulations. And fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.